In 2014, a poll of British lawmakers revealed a severe blind spot at the highest levels of government. 84% of the people writing banking laws did not know how money is actually created. That same year, the Bank of England published an official paper confirming what lawmakers missed. Private banks create money out of thin air. Most modern financial policy is built on a widely taught yet inaccurate sequence. We assume you deposit your savings, the bank keeps a fraction in reserve, and lends the rest to someone else. We treat banks as intermediaries, moving existing money from one account to another. That model is backwards. Commercial banks dynamically create the vast majority of our money supply every time they issue a loan. Seeing exactly how they do this exposes the primary mechanical driver pushing up the price of real estate and other fixed assets. Before we examine the ledger, a quick reminder: this content is for educational purposes, not financial advice. But grasping this mechanical reality is the only way you can accurately protect your wealth from systemic distortion. To see how this system operates, we have to split the broad concept of money into three distinct, functionally different categories. First, there are central bank reserves, which you and I cannot touch. Only banks use these to settle payments between each other. Second, there is physical cash, the printed notes and coins in your wallet. In the UK, this accounts for about 3% of the money in the economy. In the United States, it is roughly 10%. This chart shows the actual composition of our money supply. Notice the tiny sliver representing government-printed cash. The massive remaining block, 90 to 97% of the total supply, is digital money. The technical term is commercial bank money, created entirely by private banks. If banks truly needed to acquire your physical deposits to fund their lending operations, they would fiercely compete for your savings. Market forces would compel them to offer 10 or 15% interest rates. Instead, they offer nearly zero. They don't need your savings to originate a loan. The loan comes first, and the act of issuing that loan is what creates the new deposit. For centuries, this process was debated theoretically. Then, in 2014, economist Richard Werner walked into a cooperative bank in Bavaria. He convinced the managers to leave their books open and systems live while they processed a real loan, allowing him to observe and publish empirical proof of the exact moment of origination. This double-entry ledger balances what the bank owns on the left and owes on the right. For a $10,000 loan, your contract is an asset on the left. Instantly, the banker types a new $10,000 deposit as a liability on the right, balancing the ledger. That deposit did not exist a second earlier. It wasn't moved from another customer's account or taken from a vault. Through a simple keystroke, $10,000 of brand new purchasing power has just been injected into the economy. The absolute limit on this creation process is not a physical vault of reserves. In many Western countries, including the United States as of March 2020, the legal reserve requirement is exactly zero. The real constraints are regulatory capital rules and ultimately the bank's own internal choices about who they lend to. Let's move the timeline forward. You take that newly created money, spend it, and begin repaying the bank month by month. Look at the ledger during repayment. When you pay back the $10,000 principal, that money is not transferred to another customer. The digital ledger literally deletes the money from existence. The same keyboard that created it destroys it. But there is a second part to your payment. Over a 5-year term, you might pay an additional $2,000 in interest. That interest does not vanish. It is extracted and kept by the bank as real-world profit. Think of it like renting an imaginary car. The moment you sign the contract, the car materializes. You drive it for years, paying real rent on it every month. When you finish your payments and return the car, it vanishes exactly as it appeared. The only permanent real-world transfer was the rent the bank collected from you. Here at Learn and Invest, our mission is to demystify these exact mechanics. By supporting this platform, you help us map the complex financial architecture that dictates your daily life, bridging dense economic theory directly to your own wealth strategy. If banks possess the authority to type new money into existence, the critical macroeconomic question is, who do they actually choose to give it to? Under international banking rules, regulators require banks to hold roughly 3 times as much capital against a loan for a small business as they do against a residential home mortgage. If you run a bank, the mathematical incentive is clear. This chart tracks UK bank lending over 14 years. Small business lending stays virtually flat, while mortgage lending exploded. Trillions in newly created money bypassed productive enterprise, instead flooding straight into the property market, chasing assets that already existed. While existing properties received endless funding, the small and medium enterprises that actually innovate, produce new goods, and hire workers were starved of capital. The influx of easy bank credit pushes house prices beyond what traditional supply and demand metrics would dictate. When new money is typed into the system and flows straight into property, more capital chases a fixed number of houses, driving the price tag higher. This systemic, regulatory-driven misallocation of capital is the primary engine making housing permanently unaffordable for the working generation. Correcting this economic distortion requires restructuring the system. We must point the power of money creation away from existing assets and toward productive, job-creating businesses. For a highly centralized megabank, processing a $50,000 local business loan requires almost the same administrative overhead as a $50 million corporate deal. Local lending is simply unprofitable for giants. The structural antidote is a decentralized network of thousands of small, local banks. In these institutions, loan officers personally know the local entrepreneurs. They have the ground-level insight required to effectively underwrite productive risk. The historical proof is visible in China's rise following Deng Xiaoping's reforms in 1978. After studying Japan's post-war strategies, he implemented a radical shift. China intentionally decentralized its banking system, establishing thousands of village and local banks. They put the power of credit allocation directly into the hands of local officers on the ground, fueling historic real wage growth. The mechanism of money creation is not inherently destructive. When distributed locally and aimed strictly at production, it serves as a powerful engine for lifting populations out of poverty. You trade your hours, your labor, and your focus for wages. That money represents the storage of your limited, precious time on Earth. Every time the centralized banking system pumps new money into existing assets, it dilutes the purchasing power of the time you have already traded. The machine invisibly reduces the value of the hours you've already worked. Private banks write the majority of our money into existence, using double-entry ledgers, shaping the physical world around us with every keystroke. Consider this. How must you adapt your own investment strategy, knowing that the banking system mathematically favors inflating existing assets? Second, how can you direct your capital or your skills towards supporting local economic engines, rather than feeding centralized extraction? Finally, how can you align your daily work with building tangible, non-extractive value for others in a system that rewards the opposite? Thank you for investing your most valuable asset, your time, with us today. As always, learn and invest.